Tokyo, Washington, Brasilia. The final week of April 2026, and the world's central bankers are preparing to speak. Three major policy decisions converge on the same Monday deadline, and prediction contract markets have already priced their outcomes with striking confidence. In Japan, the Bank of Japan's April meeting carries a 98% probability of no change in interest rates. In Brazil, the Selic rate cut is priced at 97%. And threading through both is a number from Washington that has unsettled macro forecasters. The probability that US inflation will exceed 4% this year has just surged nearly 10 percentage points in a single trading session, arriving at an even 50-50. In the next 8 minutes, we trace what the crowd is telling us about the global rate cycle, inflation, and the open questions that define the macro outlook as we enter May 2026. In Kazuo Ueda's Japan, the policy calculus has been deliberate. Having ended decades of negative interest rates in a historic pivot last year, the Bank of Japan has since adopted an almost aggressive patience. Growth remains fragile. Wage inflation is real but uneven. And the yen, having navigated significant pressure against the dollar, continues to require a steady hand. Prediction market contracts on the April 2026 meeting now assign a 98% probability to no change in rates, with volume on that contract reaching nearly $17,000, the highest of any central bank market tracked this week. The opposing contract, a rate decrease, has been priced to zero. This is not market inertia. It reflects a deliberate signal from Tokyo that the BOJ intends to move at its own pace, and that pace does not include this month. The contract resolves Monday, the 28th of April. The crowd is not expecting a surprise. Cross to the Southern Hemisphere. Brazil's Banco Central do Brasil convenes its own April meeting on the same date, Monday the 28th. And the prediction market has spoken with unusual conviction. The probability of a Selic rate decrease now stands at 97%, after a 3.5 percentage point move in the prior 24 hours. The no-change contract, which briefly held credibility earlier in the week, has been priced to just 2%. Brazil's rate cycle context is essential here. The Selic, historically one of the highest benchmark rates in the emerging market world, has been maintained at elevated levels through a prolonged tightening cycle. Recent domestic inflation prints and growth signals appear to have given policymakers the room they needed. For macro investors tracking BRICS economies and emerging market rate cycles broadly, this near-unanimous pricing is a strong directional signal. The crowd has positioned itself firmly in favor of easing. The resolution is 48 hours away. Now to the number that dominated prediction market screens this week. The contract asking whether US inflation will exceed 4% in 2026 recorded the single largest probability move of the window, a 9.5 percentage point surge in a single session, arriving at an even 50%. A contract at 50% is not a consensus. It is the market's expression of genuine uncertainty, where informed participants are precisely divided. Earlier in the year, this contract had been trading in the low to mid-40s, reflecting a base case of gradual disinflation. The jump to 50 suggests that something in the underlying information has shifted. Whether it is new CPI data, energy price revisions, tariff effects feeding into the FOMC's outlook, or a recalibration of the Fed's preferred PCE trajectory, the crowd has moved. At 50%, this is now the most contested open question in macro markets for the remainder of 2026. Beyond central banks, the week's clearest expression of market certainty belongs to a single company. The prediction market asking whether Nvidia will be the world's largest company by market capitalization on the 30th of April has reached 99% probability. The longer-dated contract, will Nvidia hold that position through the 31st of May, follows at 97% volume on the near-dated contract, has reached nearly $34,000, the week's highest single market by volume. For macro investors, Nvidia's trajectory is not merely a technology story. It reflects the broad repricing of artificial intelligence infrastructure as a systemic economic force, one whose market capitalization now rivals that of many medium-sized national economies. In an environment where FOMC decisions and inflationary pressures define the macro backdrop, the crowd has delivered one unambiguous verdict: the current corporate hierarchy is expected to remain intact through the end of April. The energy market offers a contrasting picture of uncertainty. The contract asking whether U.S. petrol prices will reach $4.25 per gallon by Wednesday the 30th of April has seen its probability climb 2 percentage points in 24 hours to 15%. That may appear low, but in prediction market terms a 2-point move in a short-duration contract carries genuine informational weight. Energy markets have been processing a complex set of signals: OPEC production adjustments, U.S. strategic reserve positioning, and the broader inflationary backdrop that makes elevated pump prices politically sensitive heading into the summer driving season. For those tracking the interaction between energy costs and the wider inflation outlook, the gas price contract functions as a real-time barometer. The crowd does not currently expect the $4.25 threshold to be breached this week, but the recent uptick in probability suggests that the distribution of market expectations is quietly shifting. The corporate market cap landscape offers one further data point for the macro observer. The contract asking whether Apple will occupy the second-largest position in the global hierarchy on the 30th of April stands at just 9%, up half a point this week, but firmly in low-probability territory. Read alongside the Nvidia contract, the implication is clear. In prediction market terms, the current ordering of the world's largest companies is expected to hold through month-end, with another entity, almost certainly Microsoft, positioned between Nvidia and Apple. For macro investors, the significance extends beyond corporate rankings. The technology complex's predicted structural stability, even as the FOMC's rate path remains uncertain and the inflation contract sits at 50-50, points to a crowd that has not yet priced a meaningful equity correction. The interaction between rate expectations and technology valuations remains the central tension in the macro outlook. Step back from the individual contracts and a coherent macro narrative emerges. Central banks on hold. An emerging market rate cut in motion. Inflation uncertainty reignited at precisely 50%, technology valuations structurally entrenched. And at the periphery, one geopolitical contract worth noting: the market asking whether Emmanuel Macron will have left the French presidency by the 30th of June 2026 sits at 1%. For those watching NATO dynamics, European defense commitments, and the continent's political architecture, the absence of French political risk from the forecast map is its own signal. The synthesis for a macro investor entering the final week of April: prediction markets are pricing a world of managed continuity, central banks pausing, corporate hierarchy stable, Europe politically steady. Inflation is the one live uncertainty, the one contract at 50%. The crowd is not, as yet, pricing shock. But 50% is a very honest number. That is your weekly review of macro and geopolitical prediction contract markets for the week of the 27th of April, 2026. The Bank of Japan and the Bank of Brazil both resolve Monday the 28th. The inflation contract remains open and contested at 50%. And the deeper question, where global rates, prices, and geopolitical risk take us through the second half of the year, remains live. If this analysis is useful to you, subscribe for weekly coverage of the macro and geopolitics markets that matter. Real-time alerts when major contracts move are available on our Telegram channel, @BetTheNews. All links to track this week's contracts directly are in the pinned comment below. We will see you next week.